So if you want to learn how to invest like Warren Buffett and Benjamin Graham, then you gotta learn value investing. Basically, investing in stocks, undervalued stocks that will grow in the long term. So this is going to be a course with many different lessons. So if you are new here, you can consider subscribing for future lessons. So let's get into that. What is value investing? So basically, to put in simple terms, okay? So let's say today I tell you, today I go to the supermarket and then I bought 2 things. And then I'm seeking your advice. Did I spend my money properly? Is it worth it? Because I spent $10 to buy this one item and also $10 to buy the second item. So did I spend my money well, properly? Is it worth it? Then the second question you ask me is, so what did you buy? Because it depends. Now here's why a lot of investors lose money. They look at the price of a stock, a company, and then they decide from there, just from the price alone, whether it's cheap or expensive. The answer is, it is relative, just like this example, okay? So if I tell you right now, I spent $10 to buy a pen, just a normal pen, not some premium pen, just a regular pen, ballpoint pen. So is it worth it? Then you'll be like, why are you so stupid? Why would you spend $10 on a regular pen when you can buy it at Target, Walmart for $1? So this $10 that I spent is not worth it. I paid too much for a regular pen, okay? And then I ask you, so how about this one? Was it worth it? Then you ask me, so what did you spend this $10 on? I bought a bottle of wine that tastes really good. Then you say, the money that you spend on this bottle of wine is quite worth it. In fact, value for money. Because normally a bottle of wine is, on average, let's say $30. And the average price of a regular pen is about $1 to $2. So basically, this is the so-called real value of the product, the real value of the product. And if you are able to buy a company that is below the real value of the company, then that is what we call value investing. So basically, every single stock has an intrinsic value. Okay, so let's say y-axis over here we have value, and then x-axis over here we have time. So you can understand that the intrinsic value, meaning the real value of a company in the long term, if it is a good company, the intrinsic value will increase. Okay, but then Karen, how come every time when I open the stock chart, the price every day is different? Because you can understand the difference between market value versus intrinsic value. Okay? So the market value is the price that we saw just now. The pen and the wine is $10. And the supermarket can increase the price, and when there's a Black Friday season, they can decrease the price. Okay, so that $10 is the market value, which fluctuates every single day. So you can see Mr. Market as the supermarket. So the black color line over here is the market value. So every single day is going to give you different prices, but the intrinsic value remains steady and increasing slowly over time. So that's why when you open the stock chart every single day, Mr. Market is giving you a different price almost every single hour, every single day. Sometimes it's lower, sometimes higher, sometimes lower, sometimes higher. Your job as a value investor is to find out, are you buying the stock below the intrinsic value, the true value of the company? So your job is to buy the wine bottle at a cheap price. Okay, basically it's here, 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 meaning below the intrinsic value, which is this blue line. Okay, So let me write that down in case you are confused. Okay, and then this black line will be your market value. And when you are buying over here above the intrinsic value, okay, you are paying $10 for a regular $1 pen. Does it make sense to you? Doesn't make sense to you. So you avoid buying the stock when it is above the intrinsic value. So your job as a value investor is to determine what is the intrinsic value. And there are a lot of metrics that you need to look at to determine whether a company is good in the long term. So this is why you gotta go through this many part series course that I'm going to prepare for you in the next few months. So basically, you want to buy when it is below intrinsic value. Now, not just below intrinsic value, it has to have a proper margin of safety, because if the price is just slightly lower than the intrinsic value, then the risk to reward is not that good. You want it to be way below the intrinsic value at a big discount. So this portion over here, okay, let me put a legend over here, is the margin of safety. So basically, to be safe, you want it to be 50% below the intrinsic value to be safe. And then when the stock price goes above the intrinsic value, that's when you want to sell. So you can understand that no matter how good a stock is, in the short term, it's going to become overvalued, undervalued, overvalued, undervalued. So when it is above the intrinsic value, it is overvalued. When it is below the intrinsic value, it is undervalued. So in the short term, the stock is going to be erratic, sometimes it's going to be irrational. But in the long term, if you buy a good company, it is going to go up in the long term. So the key to become a successful value investor, stock market investor, is patience. And then you gotta master fundamental analysis. Basically, you gotta do qualitative analysis, meaning look at the quality of the company, and also quantitative analysis, meaning look at the numbers, financial statements, balance sheet, cash flow statement, and also income statement, which is what I'm going to cover in this whole entire course on YouTube. So stay tuned for that. So with that, I'll talk to you in the next video. Bye.